All right. The question is, what kind of life insurance would you get for your family in 2023? What type of life insurance is better for kids? Cash value plan or term type? Thanks for the question now. Let's go for this, man.
Let's do it.
All right. Got Chris Kirkpatrick, Life 180.
What's up, guys?
Self-proclaimed nerd.
Totally.
I call one of my buddies a nerd and he gets offended. I'm like, it's a compliment, man.
Totally.
It's a compliment.
Nerds run the world, guys.
Yeah.
Nerds run the world.
Good.
So, what's the best kind of insurance to get? I think from a high level, just starting the conversation, it's about cash flow more importantly than anything, right? And making sure that based on what your cash flow is, making sure that your insurance is doing the first job first, which is protecting your human life value and making sure your human economic value for your family is insured. And
I like having my kids to have insurance because I don't know what's going to happen to their health in the future. So 30 days after they're born is typically when you can get the insurance. Yeah. I go with cash value plans on my kids.
Well, you have to. I mean, like you can't just...
So there's one company that gives you a term rider, right?
Yeah. I mean, you cannot just buy a term policy for juvenile. Anybody under 18, you have to go permanent insurance. You got to go whole life or IUL, but please just don't do that to yourself. Just go with whole life. And we've got a lot of other videos that will explain why. We're not going to go there in this one, but like I would say, for the parents, figure out the cash flow. For the kids, I would say the greatest gift you can ever give your kids is a whole life policy starting in day one, and because you don't know in this world of the health and disease and chronic problems that we're all having in our diets, and we don't know what it's going to look like. So to be able to lock in that insurability on a guaranteed basis, you can add in guaranteed insurability riders. So when they turn 25 and 35, get to add more insurance. So maybe they hit 20 and they have diabetes or they have some other health concerns and they're not even insurable. So when they go to get married and have kids themselves, what if they can't get insurance? So for you to be able to do that for them is amazing. And then all the while you're building up a store of capital for them that you control as the parent, right? Because you own the policy. You can hand it to them at any point in time. And so what a gift.
Right. So this is what I do. I mean, when my kids were 30 days old, we got policies on them. Mm-hmm. After a while, I didn't really know how to pay them when they were really young. I mean, I guess you could pay them to do modeling and stuff like that.
Sure.
But you could pay your kids around $12,200 a year up to that amount.
It's $13,850.
Oh, it
just went up.
I just heard
this weekend. There you go.
Inflation. This is one of the things
exactly.
So $13,880 or under. And so I haven't actually increased the amount I'm paying my kids, but my kids are doing a lot now. Like my 18-year-old is traveling with me. He's handing out books the whole time at the
editing
booth.
Videos.
He's editing. Yeah, he's doing all sorts of work for me.
Yeah.
My 15-year-old opened for me when I did my comedy special. He's helped me rehearse my theatrical keynote. They've done a lot of work that is, he's introduced me at events.
It's awesome.
So I thought of all these different ways. And so when I pay them, a lot of that goes into their life insurance policy, which actually means it's tax deductible to me.
Well, explain
tax free to them, and then pay for the policy.
Because you're not really taking the money and just paying the policy with your money. You're paying them, and they're technically paying for the policy.
It goes into their bank account.
Right. And
then the premiums automatically come out of their bank.
Right.
So in essence, it's one of these really rare times that very easily you could take after, basically pre-tax dollars and still have tax advantages that don't require tax on the back end.
That's pretty sick. So think about it this way. Let's just, for round numbers, say $12,000 a year. You could pay your kid $1,000 a month, deduct that, and then pay for $1,000 a month premium for their whole life policy. You're paying for it with tax deductible dollars.
Right.
It's going to grow tax deferred, and you can get tax-free access, and you're going to have a tax-free death benefit.
Basis. There's basis.
Yeah.
Meaning the contribution that goes in is considered after tax dollars.
Right. I can't think of another instance where you can get a completely tax-free environment.
Right. It's pretty awesome.
And you can do it for your kids. But you got to make sure you structure it properly. Your family structure on how you pay them, and make sure you
really pay them for things they're doing. That's why it took me a long time to start paying my kids. Is when they were little, as what could I actually have them do, and what would that actually be worth?
Right.
So I actually created this guide And I think there's like 14 ideas on how to pay your kids in the guide. It's at garrettgunderson.com/rich life. Go to the legacy guide and go to the initiate portion of that. And you'll see the ideas, and I share the examples and how to pay kids. And, insurance is part of the strategy there. So that's a great possibility of something to do. And I don't have college funds. My 18-year-old's not going to go to college. It's not for him.
Right.
He's got a ridiculously high IQ, but he doesn't really have interest in that system. Yeah, definitely.
Okay.
And he's a lot more like her than he is me. And he's getting educated by traveling around with me and editing videos. So I like where he's at and what he's learning. But I'm glad I didn't do like a 529, because that's like an expensive version of a retirement plan for me for school, right? Yep. It's higher fees a lot of times. Volatility. I don't like them.
Yep.
The Coverdale plan. I don't like putting in all these other assets that are so market dependent and so
behavior dependent.
Yeah. Right. You have to go to this thing to get the benefit.
Yeah.
And maybe you don't want to go to that thing.
Right. Life changes. Like my daughter's 12. She wants to be a lawyer right now. And I pretty much guarantee that's not going to happen, knowing like who she is deep down. right. Like,
remember, it used to be like a totally different world 30 years ago to be a doctor or a lawyer.
Totally.
Like there was a level of prestige that doesn't really exist with that anymore.
Totally. So I mean, it's so I look at this and I think if you're a parent, think about your cash flow, break down what you can afford, from a cash flow perspective, and make sure you're working with a holistic plan that's going to help you eliminate your debt, free up cash flow. Like this has got to be part of a bigger conversation.
Right, because if you have really high interest rate loans, that might be an issue. If you have no liquidity, if you're barely making ends meet, I'm talking so those are good points to consider first.
And once you do that,
and just getting insurance on yourself.
So here's the deal. Typically speaking, you have to at least apply for insurance for yourself first, or have insurance on yourself before you're even allowed to have insurance on your kid. And typically it's about 50%.
And it's a function of how much you have to what your kids can
So
get.
if you have $1 million of death benefit, you can only own about $500,000 of death benefit on your children, right? So, just know that it's important, and like, because you can't just say, oh, like my kids are younger and healthier, and so the cash value is going to be better. No, it doesn't work that way.
Yeah, good question. Crazy that we answered it that efficiently.
Yeah, we're good. I don't know what to say. So
there you go.
Hopefully that answers your question and you're comfortable and we're good to go.
All right, build more wealth.